does work. Why? Well, listen, I'm not William Shakespeare, but, I do know what to say and how to say it through my experience. That's number one. Number two, does anybody know what May 1st is in the college timeline? May 1st is when you have to let the schools know if you're going there or not. So while some people have said, yes, I am going, thank you very much, other students have said, no, thank you, I'm going somewhere else. What happens to their financial aid? What happens to their money? Who do you think is going to get it? Your friend who just said, oh, I just heard you just say thank you and sit back and, accept it. You think they're going to get it? No. Or do you think you're going to get it who has written nice letters, diplomatic letters, stated a good cause that, that you should get more money? It works. I am telling you it works. And here's the thing. I've done it hundreds of times. Never once, not one time, has a school ever said to any of my clients, oh, well, you asked for more money, I'm taking money back. Not one time. Doesn't hurt to ask. Okay, but you just can't, I want more money. You just can't say that. You have to have a reason. Okay. And here we go. You're going to see it's all going to come together. Positioning the student. This, by far, is going to have the biggest impact on the amount of financial aid you get. Okay? You combine this with what we're going to talk about in a minute about, the financial planning aspect of it, you're going to see it has a big impact. And I preface this by saying, some of you may not agree with me, and that's fine. Everybody's entitled. I can only tell you that, it's proven that this works. I can only tell you I know how to get you a lot of money. I also will preface this by saying, I don't really include the Ivy Leagues in this conversation, but I will say this. I don't believe in the name Kosheva School. Okay? I don't think anybody can tell me that Marist is a better school than Fairfield. That Fairfield's a better school than Wilkes. Or Wilkes is a better school than King's. King's better than Scranton. Scranton better than Lafayette. And Lafayette's better than Monmouth. And Monmouth is better than Ryder. So on and so on and so on. Alright? I don't think the diploma, the name on the diploma makes the student. I think the student makes the diploma. If your student works hard enough, he will get a good education. Right? And you all say, well, this school's a good engineering school. Says who? So, oh, well, I work at an engineering I work at an engineering company, and Lehigh had sent these kids over, and they were great. Well, how many kids were there? 2 or 3? Suppose they sent 20 over, and the rest of them stunk. You can't tell me that XYZ school is better than ABC school. All right? And let's be realistic. All right? You're sending your students to college for what? Everyone's going to say to get an education, right? Well, yeah, you can think about it, but once again, let's talk about the end game. Why are they getting? You're really sending them to college so they get a good job and they move out, right? That's why you're really sending them to college, because if they don't get a good job, they can't move out. Education, all you want, but they need a good job. And they're going to get a good education if they work hard enough. Okay? If they go to school, and listen, Mom and Dad, it can be a party school if they want it to be a party school. That's the reality of the situation. They can go to Harvard. It can be a party school. They can go to Sussex Community College, and it can be a great school. Right? They don't have you to wake them up to go to classes. They don't have you to make sure that they don't cut class. They don't have you to make sure that their homework is done. They're on their own for the first time. If they want, it can be so. Any school can be a party school. That's what I don't buy into that, and I don't buy into the rankings either. Right? I've seen too many people make millions of dollars who went to William Patterson Rutgers. That you ever wonder? Hey, let me ask you this: what's more impressive to you? An A at Rutgers or a D at Harvard? How do you know how the kid got into Harvard? Maybe his father donated a wing. Maybe, he's a C student, like George Bush. You never know. But, like I said, I don't believe that you should pay more because of the name of the school. And, kind of joke around, say, oh, you want the name on the sweatshirt. Well, buy the sweatshirt. Okay? Buy the sweatshirt. And I honestly think that people in this country, people in general, maybe not in this country, they look at college more as a commodity rather than they should as a consumer. You know, they look at it, oh, he has to go to this college, he has to go to the name college. All right, well, you know, he really wants to go to this college and loves this college. Well, we talked about that before, that's all well and good. But he'd probably really love a Corvette too, right? Or a Porsche, right? Or a Mercedes. Are you going to get it for him? No. Why not? He really loves it. It's a good car. It's a better car than a Toyota, right? So why aren't you going to get it for him? It's not practical. All right? We have to start looking at college like you're buying a house. You have to start looking at it that way. You don't want to hear it, but that's the truth. Everybody wants the $10 million house with the swimming pool and the steam showers and the granite kitchen. Everybody wants it. Can you afford it? And that's what's happening. That's what we got in this housing mess for. And I'm telling you right now, same thing's going to happen with student loans. Everybody wanted the house. Oh, we'll buy the house and worry about paying the mortgage later. How many of you have heard that? Worry about getting in and pay for it later. If you hire a guidance counselor, counselor, you should fire them for that if they say that to you. Worry about get in and worry about paying for it later. We're talking almost $60,000 a year. How can you worry about paying for that later? You could certainly take out loans, absolutely. But once again, is that really what you want? Is that really what you want? You have to start looking at it like, can you afford it? Because the same thing that will happen in the housing market with all the defaults and all the foreclosures is going to start happening with student loans. Because everybody got in and worried about how to pay for it later. Last month alone, I had a few clients, for the first time, I can't make my student loan payments. The parents weren't doing as good as they thought. Students didn't get a good enough job. And now they had to go to the University of Michigan. Had to. I had a lady sit in my office. Daughter had to go to Brandeis. Had to. I said, what's so great? Tell me, what's so great about Brandeis? Brandeis. And the lady, she had some health problems, and she made a lot of money now. But because of her health, she would have to retire next year. But she made a lot of money. And of course, just like everybody else, like all of us, she lived above her means, so she didn't have a lot of savings. So she doesn't have money to pay for college. All right? So I said, all right, let's take a look at Brandeis. What's your daughter's SAT scores? All right. Looked it up. You're not getting any scholarships from Brandeis. $50,000 school. How are you going to pay? Oh, we'll worry about that later. Had to go to Brandeis. You know where this is headed, right? They gave her $10,000. Oh, thank you very much. $40,000 to pay. The daughter is taking out $40,000 a year, and she's on a 6-year program. You can do the math. The daughter is starting her life out with $240,000 in debt. Do you think that she's ever going to be able to buy a house? I mean, you got to start thinking college as a consumer nowadays. And I hate to say it because, listen, I have 2 kids and I'm scared to death of what's going to happen. When they're older. But the fact of the matter is it is out of control. And you have to start looking at college. Can you afford it? Yeah, your son or daughter really wants to go there, and we realize that, and you want to send them there. Can you afford it? You can't get water from a stone. And we already said if you don't get money from a $50,000 school, you can't go. You can't write the check. So, it's just a matter of how much debt you're willing to take at that point. All right? Or you can do it the right way and position your student to get the maximum of the Boston University type money. And how do you do that? Well, if you use the old antique way of, school selection, how many of you have heard reach school, safety school, mid school? How many of you have heard that? Well, that's fine. But if you do it that way, you're cutting yourself off. Why? If you apply to a reach school, you're basically saying to them, and by the way, schools have reach students and safety students, okay? So if you are applying to a reach school, you are a safety student. Everybody see that? So if you apply to a reach school, You are basically saying to them, please, please, please let me in. I know I am below your profile, but please let me in. And they're going to say to you, well, let me just change this. Well, you can come to our school, but because you're below our profile, you have to pay more. Okay, you have to pay near sticker price. 50, we'll give you 10. Okay, because schools have a cost. Let's say at $50,000, I don't know what they are. Let's say at $50,000, their cost is $25,000. So yeah, we'll give you 10 because we need the safety student money applying to the REACH school. We need your extra money to subsidize the REACH student applying to the safety schools. We need to attract these students, and how do schools attract students? With money. So they take your money, the safety student applying to REACH school subsidizes the REACH student applying to the safety school. That's how it works. So when you apply to a REACH school, don't be surprised to say if you ever wonder, hey, how'd that kid get into that school? That's how. They're paying top dollar. They're paying sticker price. And remember, only rubes pay sticker price? That's why. Oh, please, please, please let me in. Is it right? You know, and I told the lady, I said, you know, you could go to Bentley, and Bentley's going to, you know, look at these scholarships, $10,000, $7,000, $5,000. You can get these scholarships. Oh, gotta go to Brandeis. Do you really think Bentley is that much below Brandeis that she's, I mean, is it worth it? Not me. Not me. You know? So, how do you do this? Well, what you want to do is this. You basically, you're marketing the student. You basically take your SAT scores, old SAT scores. Forget about this new, you know, I don't know if you're aware of it. The College Board in its infinite wisdom a few years ago included this writing sample. Don't get me started. No schools look at the writing sample. Math and reading, okay? It used to be verbal. Math and reading, okay? You combine those two, all right? And if, let's say you have a 1200. If you apply to a 1400 school, you're a REACH student applying, I'm sorry, you're applying to a REACH school, you are a safety student. Okay? They're going to say, oh yeah, they may let you in, but if it's a $50,000 school, oh, they may give you 10. And you're, oh, thank you, but yeah, you know, the cold water's going to hit you, oh, you still have to pay 40. Okay? And I know you don't want to hear this and you might not agree, but, you know, I'm telling you how to get money. Okay? What you do is you take that 1200 and you apply to 1200 and below SAT schools. Okay? And that's where you get the money. You combine that with the financial planning that we're going to talk about in a minute. That's where you get Boston University type money. Okay? Now, in a perfect world, your student would go to Boston University. All right? It's not a perfect world. Let's suppose she wanted to go to Delaware. Okay? What we want, you know, it's not necessarily that you have to go to these schools. Ideally, it would be great. But what you want is 3, 4, 5 of them to give you these Boston University type award letters. So now you have the leverage going forward for negotiating. Remember how I said it was going to come full circle? Yes, I know there's an application fee involved. I understand that, and it's not fun. Okay? But if you do this the right way, all right, you will get money. All right, you will get the money, whether it's a couple $1,000s extra in negotiating, or whether you get the huge scholarships at Boston University. This year alone, a client called me up, Rider University, gave her $15,000. She would never have thought of Rider, but it was on the list I gave her. So she looked at it and said, oh, let's apply there. And the daughter loves Rider now. Never would have thought about it, but it's on the list. A couple of years ago, University of Hartford. Client called, never would have thought about it. Going to University of Hartford, about $20,000. It's a $50,000 school. You know, in a great situation, you know, I give you the list. You look at let's take a look at this. And your student loves the school. Okay? Worst case scenario, you have a list of schools that you know you have in your back pocket that's going to give you scholarships for leverage. All right? That's what we're looking for. And I know you don't want to play the game. But they're going to charge you $50,000, $60,000. You better play the game, or, you know, what else are you going to do? Okay. Now let's talk real quickly. I know I'm running late. I'm sorry. 5 more minutes. Includable versus non-includable assets. What you want to do, When you're applying for financial aid, in an EFC formula, there are includable and there are non-includable assets. Technically, what you want to do is you want to move your includable to your non-includable. Non-includable assets it could be your home, depending upon the school, any type of retirement account, 401k, 403b, whatever it may be. Cash IRAs, simple IRAs, SEP IRAs, Roth IRAs, cash value life insurance, tax-deferred annuities, all non-includable, okay? What you want to do, move the money from includable to non-includable. Look at this example. Right from my case files. This family had $74,000 of includable assets. I'm sorry, of income. All right? The assets, the parental assets, were $275,000, which included $200,000 of home equity. You see that there, right? Notice the home value. All right? The student had $8,500 in their name. We know how we feel about that. The federal EFC was 14 and change. Institutional EFC was 20 and change. Got a little smart, did a little planning. Notice the income. When you move the assets, the non-includable assets are what's called tax-deferred typically, which means there's no interest income, dividend income, capital gains income. Now, think about it. This family saved an additional $4,000 of taxable income, financial aid income, besides the assets that we're saving. Now, parental assets. Parents get what's called an asset protection allowance. So besides only being assessed at 5.6%, parents are allowed to have a certain amount of assets in their name before they're even assessed. This family was about $47,000. We brought it down to that amount. Look at the home. $400,000 to $269,000. That's the housing index multiplier. Once again, never been questioned, so I'm going to keep doing it. All right? The family wanted it, the wife wanted it to redo the kitchen. They've been planning it. She didn't want to do it. They're worrying about college. Should we do it? Listen, either college is going to take the money or you could redo your